Hey everyone, and welcome to This Explainer. Today, we're unpacking the real engine behind true passive income, dividend investing. We've got some great charts and diagrams lined up to make the math super clear, so if you're looking for a structured blueprint to make your money work for you, you're absolutely in the right place. Let's get into it.
So, have you ever wished your investments could literally pay you even when you aren't working? Just imagine waking up, checking your account, and seeing that cash has been deposited into your portfolio while you were sleeping, or, while you were on vacation, just living your life. That dream scenario is exactly what dividend investing is all about. It's a strategy that lets you generate a steady stream of income without having to constantly buy and sell stocks. To understand how we actually get to that dream scenario, let's cover the basics. Section 1. What is a dividend? Simply put, a dividend is a portion of a company's profits that it shares directly with its shareholders, usually every 3 months. When a company does well and brings in a profit, management has to decide what to do with that extra cash. And for dividend-paying companies, they decide to take a slice of that profit pie and hand it right back to the people who own the company, the investors. The coolest part is, it's honestly like getting paid simply for being an owner. Think of it like this. Imagine you own a tiny piece of a massive familiar company, say Coca-Cola or Johnson & Johnson. Because you own shares, you're a part owner. If they sell a ton of products and make a healthy profit, they can choose to reward you for your investment. You didn't have to clock in, you didn't have to manage their supply chain, you literally just get paid because your name is on a piece of paper saying you own part of the business. Now, you might be wondering, why doesn't every single stock on the market do this? Well, it really comes down to growth phases. On one hand, you have fast-growing companies. Think of new tech startups. They usually take all their profits and reinvest them right back into the business to build new factories, hire staff, or research new products. On the other hand, you have established companies. These are the giants that have already scaled. They generate so much steady cash that they don't need to reinvest every single penny to grow, so they pay those extra profits out as dividends to shareholders like you. All right, now that we know the what, let's dive into the math. Section 2, Understanding Dividend Yields. You're going to hear the term dividend yield constantly in the investing world. It's basically a metric showing how much annual dividend income you receive compared to the stock's current price, expressed as a percentage. This is super important because looking at a flat dollar amount doesn't actually tell you how good of a deal you're getting. You need this percentage to accurately gauge your potential income stream relative to what you paid for the shares. Let's look at this table to see the math in action. If you buy a stock for $50 and that company pays out $2 per share annually, doing the math gives you a 4% dividend yield. It's just a really clean, visual way to see exactly what your money is earning for you over the course of the year. Keep in mind, this yield can fluctuate if the stock price moves up or down, or if the company changes its payout. To put that into perspective, what does a 4% yield mean for your wallet in the real world? Well, if you were to invest $1,000 into that exact stock, assuming the dividend stays the same, you'd receive about $40 per year in pure passive income. That's $40 generated by your money, completely independent of your own physical labor.
Now, $40 might not sound like a life-changing, retirement funding amount of money right now, but that brings us to the most exciting part of this whole explainer. Section 3, the magic of compounding.
Look at the bar chart right here because this is where the magic happens. Your original investment pays out a baseline dividend. But if you reinvest that cash instead of spending it, those dividends automatically buy you more shares. And guess what? More shares mean a larger dividend next time. Then those larger dividends buy even more shares. This is the compounding snowball effect in action, growing your wealth exponentially over time without you adding another dime. Long-term investors usually set this up on autopilot using things called DRIPs or dividend reinvestment plans. But of course, you can't just pick random names out of a hat. What makes a good dividend stock? You want companies with a long history of paying dividends, highly consistent earnings, a reasonable payout ratio so they aren't stretching their cash too thin, and strong overall financial health. Most importantly, look for a history of increasing dividends over time. There's actually a whole class of elite, well-established companies called dividend aristocrats that have successfully increased their payouts for decades. As enthusiastic as I am about this, it's my job to make sure you have the complete picture. So let's look at Section 4, Risks and Rewards. Because while this is a really powerful system, it's definitely not risk-free. Let's start with a really crucial warning. Sometimes you'll see a stock with an incredibly high dividend yield, like 10 or 12%. And you might think you struck gold, but honestly, that high yield is often a massive red flag. If a company's underlying business is struggling, its stock price is going to drop. And as we learned from our math table earlier, when the stock price drops, the yield percentage artificially shoots up. A struggling company could be forced to reduce or completely cut its dividend, and you could lose money overall if the stock tanks. So how do we mitigate that risk? Take a look at this donut chart showing a diversified portfolio mix. Don't make the mistake of putting all your cash into a single company. If they slash their dividend, your income stream just disappears. By maintaining a healthy mix of single dividend stocks, growth stocks, and crucially, dividend ETFs, you significantly lower your overall risk. An ETF, or exchange-traded fund, lets you own tiny pieces of hundreds of dividend-paying companies all at once. It's a real game changer.
All right, we've covered the what, the why, the math, and the risks. Let's move to Section 5 and bring this home with a practical plan. How to start investing. Getting started is honestly much easier than people think. Step 1, just open a standard brokerage account. Step 2, decide on a regular investment amount. Seriously, it doesn't have to be thousands of dollars. Even $50 to $100 a month makes a massive difference over time. Step 3, do your research to find quality companies or ETFs. Step 4, turn on that drip for automatic dividend reinvestment to get your snowball rolling. And Step 5, stay invested and be patient. Because remember, dividend investing is a marathon, not a sprint. It's a highly disciplined approach that rewards patience and consistency above pretty much everything else. This is definitely not a get-rich-quick scheme. It's all about building a solid portfolio that quietly and steadily generates income for you for years or even decades to come. Which brings us to our final thought. The math and the charts we've looked at today prove one undeniable fact. The earlier you start, the more time that compounding snowball has to work in your favor. Time is literally your most valuable asset here. So my question to you is, what are you waiting for? I hope this structured look at the data gives you the confidence to start building your own wealth snowball today. Thanks so much for joining me on this explainer, and I'll catch you next time.